Hello, this is Dave from N4T25 USA, Inglorious Patriots. It is Saturday, January 17th, 2026, and the time now is 21:15 hours Eastern Time here in beautiful southern North Carolina. Now, for my last couple of videos, you noticed that I have been diverging from the usual political content, which is done for a reason. Because what I am covering in the last 3 videos, and this one included, is the absolute most important thing that you can pay attention to in the next 3 months at least. Let me explain to you what is happening. I worked as an IBM customer engineer on Wall Street and on Wall Street West for 25 years. And I knew about this Ponzi scheme a long time ago. But it was accepted as normal and legal, and it still is. And I say, if you want to bet on the outcome of something, go to Las Vegas and take your Ponzi scheme off of Wall Street. For every ounce of physical silver that exists, there are up to 250 contracts bidding for that ounce of silver. And the banking system is the same way. When you put your $100 or $1,000 into your bank account, it doesn't stay there in a vault with your name on it, waiting for you to take it out, compounding interest daily at 3%, while the inflation is 15%. Okay? It doesn't work that way. When you put your money into your checking account or your savings account in a bank, they turn around and immediately lend that money to somebody else, who then deposits it in that account, and that counts as 2 deposits with the same amount of money. And they only have to have 10% of it available, because 10% of the people are not going to come to the bank and say, give me my money, unless something strange happens, which is like about to. The same way with silver contracts, the same way with stocks, stock options, stock warrants to buy stocks, and all of that. But concentrating primarily on physical silver at the moment, there isn't enough to meet demand. Silver is funny, because gold, all the gold that was ever mined, practically all of it, is still in existence. Silver, on the other hand, gets put into smartphones and electronic devices in such minute quantities that it is impossible to retrieve it for recycling at a reasonable price. You might get 1/10 of an ounce of, not even 1/10, 100th of an ounce of silver out of the contacts in the smartphone, but it costs you more than the stuff is worth to process it into a usable form. So, for all practical purposes, the majority of silver being taken out of the ground, and the majority of silver that's being bought and used in commercial applications, is gone forever. 4 kilos of silver is used in every missile that they send over there to blow shit up over in Iraq. You think they're going to sift through the dirt to get those little pieces of silver out so they can melt them down and take it to the junkie and get their $79, whatever it's worth? No. So for all practical purposes, it's gone forever. And when you're using more than you're supplying, pretty soon, eventually, inevitably, the supply is going to run out. And the people who are holding the physical metal, you want it? You're going to pay me what I ask for it. It's the bottom line. And the people who are holding physical contracts, they're screwed. Because if they demand delivery, there is nothing to deliver. So the exchanges do one of two things. They raise the margins, and they call up the guy and say, hey, you want to hold your position? You got to give us another $35,000. And if you ain't got the money, they sell it at the market, and you take the loss. Or they can do another thing called force majeure, which is, we don't have the metal to give you, we'll just close your contract, and you don't have a say about it at all. So the only way to have any value at all in the commodities market is physical possession. Physical possession. Got more than this. But physical possession is 99.9% of the law. And when you have physical possession, somebody who wants to buy it has to give you what you ask for it. Now, anybody who's holding stacks of silver from years ago, like I have, I've been stacking silver for a long time. I bought silver bars, 1 ounce bars, for $21 back in the 70s. Okay, and I still have them. Yeah, it took 50 years to get to where it is now. But the U.S. Mint just came out and said, you want a silver eagle? Going to cost you $175 a minimum. Because that's what it cost us to go on buy the metal to get the blanks to make the coinage. Watch what happens Monday. Monday is going to be a shitfest. Those banks and those private investors, I use the word loosely, investors, because they're not investors. They might as well be bidding on who wins the Super Bowl in Las Vegas. And they're going to lose. Because if you're short on silver, you are going to lose. Take your losses now. Sell your contract to some fool who wants to buy it. Because it's going to be liquidated one way or the other. And the price of silver, let me make another thing clearer. Everybody has cash in their wallet. Okay? This isn't worth a lit fart in a wool mitten. The only reason it buys anything is because the fool you're handing it to believes it's worth something. Iran's currency just collapsed. It is literally not worth a lit fart in a wool mitten right now today. And the people are rioting and threatening to hang whoever's in charge, because ultimately it's the politicians who allow this shit to happen. Just like it's the politicians who allow all the fraud and all the money laundering and weapons trafficking and drug dealing that happens. They are the ultimate people who are responsible. The Biden administration was responsible for upwards of 20 million non-uniformed enemy combatants imported into this country at your expense. The taxpayers paid for that shit. The taxpayers paid $19 billion for child care in Minneapolis. The Minneapolis Leering Center. They can't even spell the goddamn thing. For a bunch of inbred, low IQ people that the only thing that they know how to do is scam people. And I just caught a guy on eBay selling coins that he says is 0.9999% silver, and they're neon steel brass pewter solder. I bought a bunch of them. Guess what? He's going to pay me market price when I get them and test them and discover what I already know, that they're fake. So he's going to get a letter, a registered letter serving him with papers and small claims. I want my silver. I want what you advertised and I paid for. And you're going to pay me asking price. Or you're going to replace those bullion coins that I bought at cheap. Because you put them up there cheap, but you represented them as 9999% silver. You won't pay me. And then I'm going to go after eBay for allowing it. You think I'm fucking around? I'm through being fucked with. I'm done. I'm done. And there's a bunch of laws that regulate that crime that was committed, and I'll read it to you in a minute. Hold again. Here is what Microsoft Copilot says. I asked it, is there a law that outlaws selling fake bullion or coins representing them to be 9999 pure? If so, can you cite the statute and penalties? Absolutely, and the answer is yes. Federal law very much criminalizes the selling of fake bullion or coins falsely represented as 999 fine or otherwise pure. The statutes are older than the modern bullion market, but they apply directly because they cover any counterfeit gold or silver bar or coin. Below is the clean citation grounded breakdown. 18 U.S. Code, Subchapter 485, Coins or Bars. This is the primary federal statute that criminalizes making or selling counterfeit bullion bars or coins. The law applies to any falsely made, forged, or counterfeit gold or silver coin or gold or silver bar, whether U.S. or foreign, whether stamped with purity marks, e.g. 999 fine or not, and it applies to selling, passing, uttering, or possessing such items with intent to defraud. The search result confirms this directly. 18 U.S. Code 485 covers anyone who falsely makes, forges, or counterfeits any gold or silver bar or passes, utters, publishes, sells, possesses any false, forged, or counterfeit coin or bar, knowing the same to be false, with intent to defraud. Penalty under Subchapter 485 up to 15 years in federal prison. Fines, no statutory cap, governed by U.S. Code 18 U.S. Code 3571, I'm sorry. Related statutes, 18 U.S.C. 331, mutilation, diminution, and falsification of coins. Related counterfeiting statutes when bullion is marketed as currency, 18 U.S. Code 471, 18 U.S. Code 472, passing counterfeit obligations, 15 years or more. You think I'm fucking around? You advertise a coin that you say is 999% pure. It's stamped that way. You show a picture of it on your website and you sell it for $37, which is $35 below the spot price. Could be a fluke. It could be somebody who's posted it, who bought it at $15 and thinks he's doubling his money. That's possible. But I want my silver. You said it was silver, and when it comes here, I'm going to videotape the whole fucking thing, opening the package and everything. I'm going to expose the whole fucking thing. And he's going to pay me my silver at the market, or he's going to go to jail. And that's what they should do with this commodities trading, this futures trading, where you buy a contract and you have no intention of taking possession. And another thing about this commodities market now that's really got them screwed is that you have a contract, and you say, in March of 2026, I have the right to buy silver at $75 an ounce. Now, if it goes to $95 an ounce, you made out like a bandit. Okay? But if it goes below, you lost. Because the price in the future is lower than the price to buy it now. You follow what I'm saying? It's called backwardation. If it costs more to buy it now than to buy it 3 months from now, why would you buy it 3 months from now? You'd buy it today and have it, rather than wait, and who knows what's going to happen 3 months from now. But the U.S. Mint posting the price for a Silver Eagle at $175 is going to really screw these people big time come Monday morning when the market's open. Now, they're open with limited times because of the Martin Luther King holiday. That's another clusterfuck of the 11th magnitude. When the markets here close, markets in Beijing going to give a fuck about Martin Luther King's holiday, and they're going to keep trading, and they're going to keep bidding the price up, and the short sellers are going to be holding air. And talking about holding air, how about Bitcoin? I had the opportunity to buy Bitcoin when it was $1 a coin. I should have bought 1,000 coins just for shits and giggles, but you know, hindsight is 20/20. I remember it went up to $120,000 a coin. The numbers went so high that they had to break it down and make it. You got Bitcoin, and then you got Satoshi, named after the guy who allegedly invented this shit. Basically, Bitcoin, or any cryptocurrency for that matter, is fiat currency without the fiat. See, I got dollar bills. I got $20 bills. I got money in a safe in paper money, because if the credit cards don't work tomorrow, the ATMs go down because of some EMP, or the son decides to take a shit, at least I can go and buy a loaf of bread at the store. The cash registers don't work, but the teller behind the counter will take the money, hopefully. But if you got Bitcoin, and the only way to trade in Bitcoin is to punch your numbers into a machine, and the machine don't work, or you forgot your password, you're screwed, Jack. You're screwed. The guy's lost $20 million on Bitcoin because he forgot his little phrase in his phone. He lost his phone, or he broke his phone or some shit, and his passwords and his things was on his phone, and that's the only way he kept them. So now he's screwed. There ain't no way to recover that. Drug dealers down in Venezuela allegedly did this transaction with Bitcoin and cryptocurrencies to the tune of $20 billion or something. And the U.S. government cryptography division can't break the code to get into this guy's account. So if they can't do it, ain't nobody be. If the United States Department of Defense cryptography division can't break the code, even with their supercomputers and their ultra computers and D-Waves and all that other shit, if they can't do it, ain't you gonna do it by hacking. And if you got crypto, you're screwed. For me, if I had $1 million in Bitcoin, I'd transfer it and I'd buy physical silver and take possession. I would take possession of it. Because physical silver, you might say, well, they'll come after the silver like they came after the gold in 1933. They'll outlaw the possession of silver. They'll come and get it. Yeah, come and get it. Come and get it, motherfucker, because when you come and get my silver, you're going to walk out with lead. Bring your alchemists. So anyway, best idea I've had in a long time. I bought silver back last year, June of last year. That doubled. And I bought a whole bunch of it this year, and that's going to double Monday morning. And if I was you, I can't give you any information. I can't give you financial advice. I'm not a financial advisor. And financial advisors aren't financial advisors because they ain't got a crystal ball. So they're saying they're experts. Are they telling you what this Chinese guy that you were about to see is going to tell you? They're not telling you that. Is the news telling you that? No, they ain't telling you that. Because if they told you that, you'd go out and buy silver, and the price would go out absolutely batshit crazy. And the banks don't want that. The banks want to dip the price down so low that the people who are actually holding silver are afraid it's going to go down to $25 like it was in the 1920s and sell what they got and say, well, I'll take a loss, but at least I won't go broke. And then the next day it goes up to $175 an ounce. And then you're sitting there holding your dick saying, what the fuck did I do? Unbelievable. And these Ponzi schemes are running throughout Wall Street. And all you have to do is look at the GameStop thing that happened. They sold more stock than actually existed. So when the people on Reddit bought the stock and said, nah, I'm keeping this shit. I want GameStop in business so I can go and get my latest Xbox terminal and, earphones or whatever they do to play these games. I want them to stay in business, so I'm going to buy the stock. I'm going to buy the stock, and I'm going to keep it. I'm going to hold it. And then when Wall Street went to, cover their shorts because the stock went up, there was no more stock to buy. And the same thing's happening with silver. All these people holding short contracts at silver at $75 an ounce, if they ain't liquidated already, they're going to get margin calls. And they probably already got margin calls. And then when it goes up to $175 an ounce, they're going to get another margin call. You might as well have bought the fucking thing to begin with and save yourself all the aggravation. You see, when you have physical silver, when you have it in your safe, I'm not talking about a safe in the bank, I'm talking about a safe in your house. When you have physical possession of your silver, you can look at the market, you can look at the charts and say, look at what these assholes are saying silver is worth. And when they dump the price on the COMEX, you'll say to yourself, time to buy some more. Go down to $75, I'm buying bullshit no more. Because I know that sooner or later, your stock is going to run out. Your safes are going to be empty. And then who are you going to come to get silver? You're going to get all the stackers to give up their silver? I don't think so. I don't think so. And this shit is all politics. Because if it wasn't for the politicians, this shit wouldn't happen. Back in the day, before they had these computers, you didn't have all this instant trading and algorithms searching out who's got the stops at $75. They got what they call stop loss orders. It's all on the computer. And the banks and brokerage houses have access to all these people who got these short stop orders, stop loss orders, at what price. So they know how far they have to bang the price down to get all these people who can't afford it to get margin calls. And then they up the percentage on the margin calls so they can't afford to have the margin call, so that their contracts get liquidated at the spot price, which they probably paid more for, and they're sitting there holding their schlong, wondering, what the fuck did I do? But if you're holding physical silver and you're watching the screen and the price goes up to $175, you can't press a button and sell your silver somewhere. You got to go through a process. Worst case scenario is you take your whole stack and you go down to the pawn shop, and he might give you a spot for it. Might. Because you don't know where it's going to go. So if you're holding for the long term. You're holding until the price settles out at multiples of what you paid for it. I don't have that much money, but what I've got, I want to keep. And the reason that all these prices are going up, the reason that grocery bills are going up, is not because bread costs more money to make. It's not because, it costs more to wash your car than it did 10 years ago. It didn't cost more to fill your gas tank now than it did 20, 30, 40 years ago. I remember when premium gas was 35 cents a gallon and diesel was at least 50% less than that. Now it's the other way around. And gas is here, it's $2.90, $2.70 a gallon right now. I remember when gas was 35 cents a gallon for premium. That's when they had leaded gas. Okay? It's not that the gas got more expensive to make. It's that your money isn't worth a shit. People bought houses. I bought a house with my father in 1980, 81, 82. No, it was earlier than that. It was 1978, I believe it was. We paid $65,000 for a two-family house in Queens, New York. That house today is over $500,000. Why? It's not because the property went up. It's because the money ain't worth shit. And believe me, next to Bitcoin, U.S. fiat currency is the second runner-up on the lit fart in the wool mitten category, and it's going to be fiat. It's going to be worthless in the next year or two. It's going to be worthless, like every other fiat currency ever invented since the beginning of time. Physical metal has always been worth something. If it's not a profit, if you're not in this for the profit, you're not in it to make money. You trade Bitcoin and tulip bulbs on Wall Street to make money. You stack silver in case the shit hits the fan. Unless the caca hits the air movement device, you got something that you could barter with, something you could trade with. This, silver, tobacco, coffee, and bullets. Beans, bullets, and butter, I guess. Anyway, watch the Asian guy, subscribe to his channel. He really knows his shit. He's got at least a dozen channels that I know of, and a couple of people have stolen his narrative and his face and all that. But the ones I linked to his originals that I've been following for a while, he'll teach you something that you don't learn in school, and the news ain't going to tell you. And he's absolutely 100% right. I've worked on Wall Street 25 years. I know all the bankers, all the brokers. I talked to all of them. I bought a stock called Carolina Space Stations back in 1978. And it was just a red herring. It was no proof of concept, no nothing. It was just some idea some guy had, and he put it on the pink sheets and the penny stocks. It went from $1 a share to $7 a share. I bought 2,000 shares. I made $14,000. I bought a car with it. So, but it wasn't even a company. It was just smoke being blown up people's ass, and people bought it. It was in John Holmes's profit strategy letter, and that became a self-fulfilling prophecy until he died. But this thing here, absolutely 100%, is absolutely true. You should listen to it. If you got anything, I can't tell you what to do. I'm not your mother. Not a financial advisor, but I tell you what I did. I put a shit ton of money into silver, and already some of it already doubled from last year. And this year, Monday morning is going to be the test. It's going to shake out all the assholes. And March is the delivery month of some of these contracts. They're going to demand delivery, and they're not going to have the silver to deliver. They're going to short out, and banks will go bankrupt over this. Trust me. Watch this.
The United States government just tipped its hand. For the last 72 hours, investors have been staring at the COMEX ticker, watching the price of silver battle around $90. They have been analyzing the charts, stressing over the dips, and wondering if the bull market is over. But while the public was distracted by the volatility on the screen, the United States Mint, the sovereign entity responsible for the nation's coinage, quietly updated their internal pricing. And the number they published is not just a price increase, it is a confession. We have confirmed reports that the U.S. Mint has repriced the Proof American Silver Eagle to $173. They have repriced the uncirculated bullion version to $169. Let that sink in for a moment. The spot price on your screen is $90. The government price is $173. That is a premium of nearly 100%. This is the sovereign leak. It is the moment where the entity that prints the currency admits that the currency is broken. Now, the skeptics will say, but the mint is closed. Sales are suspended. This price doesn't matter. I'm here to tell you that it matters more than anything else in the market right now. Why would a government agency, which is currently refusing to sell coins because of a pricing backlog, go into their system and nearly double the price tag? They are doing it because they are front-running the reality. They know that when they finally reopen the sales window, whether that is next week or next month, they cannot sell silver at $90. If they did, they would be looted. They would be selling a strategic asset for pennies on the dollar. By setting the price at $173, the U.S. Mint is signaling where they believe the clearing price actually is. They are telling you that the paper price of $90 is a fiction. It is a derivative illusion that has no bearing on the cost of physical replacement. This creates a two-tiered reality. In Tier 1, you have the paper traders on Wall Street, swapping digital contracts back and forth, pretending that silver is worth $90. In Tier 2, you have the physical owners, the mint, the dealers, the industrial buyers, who know that if you actually want to touch the metal, you have to pay double. This disconnect is the definition of a broken market. When the spread between the paper price and the physical price hits $80, the exchange is no longer discovering price. It is discovering insolvency. Think about the psychology of this. If you are a retail investor and you see the government pricing silver at $173, are you going to sell your stack for $90? No. You're going to hold. You are going to wait. You're going to realize that your asset is worth far more than the bank is willing to pay you for it. This destroys the liquidity of the short sellers. The banks need you to sell so they can cover their positions. But the U.S. Mint just told every silver owner in America to hold on for dear life. They have inadvertently created the ultimate diamond hand narrative. And let's look at the timing. This repricing happened on a Friday afternoon, right after a massive attempt to smash the paper price failed. The banks tried to drive his silver down to $86. They failed. The market closed the week above $90, the first weekly close above $90 in history. And in response, the Mint raised their price to $173. This is a war between the deflationary forces of the paper market and the inflationary reality of the physical world. The paper market wants lower prices to protect the dollar. The physical market demands higher prices to justify production. The U.S. Mint has chosen a side. By pricing at $173, they have aligned themselves with the inflation trade. They are admitting that the purchasing power of the dollar has collapsed, to the point where a 1-ounce coin costs nearly 200 units of currency. This is what a currency crisis looks like in real time. It isn't a sudden crash to zero. It is a series of repricings where the cost of real assets jumps overnight to reflect the debasement of the money. We are living through the great repricing. The screen says $90. The mint says $173. Which price is real? The price where you can buy a digital contract that might be settled in cash? Or the price where you can buy a physical coin that you can hold in your hand? The answer is obvious. The physical price is the real price. The paper price is a coupon that is about to expire. But if the mint's repricing was the signal, what happened in the vaults on Friday was the action. While the mint was updating its website, the commercial vaults at the COMEX were being raided. We witnessed one of the largest single-day withdrawals in the history of the exchange. In the next part of this deep dive, we are going to analyze the Friday night heist. We are going to break down the data showing that over 4 million ounces of silver vanished from the COMEX in a single trading session. We are going to explain why the banks smashed the price to $86 not to profit, but to provide cover for this massive withdrawal. They needed to lower the price so they could loot the vault at a discount. The mint told us the value. The vault told us the scarcity. And together they tell us that the game is over. While the United States Mint was busy updating its website to reflect a $173 price tag, a very different kind of operation was taking place in the dark corners of the financial system. We have analyzed the daily warehouse reports from the CME Group for Friday, January 16th. These reports are usually boring. They usually show small movements of metal in and out of the vaults. A few thousand ounces here, a few thousand ounces there. But on Friday, the report screamed bank run. In a single 24-hour period, over 4.2 million ounces of silver were physically withdrawn from the COMEX vaults. Let me put that number into perspective. 4.2 million ounces is roughly 130 metric tons of silver. This is not a retail investor buying a few coins. This is not a jewelry maker buying supplies for the quarter. This is a fleet of armored trucks. This is a cargo plane. This is a strategic exodus. We need to look at exactly who was drained. The data is specific. 1.4 million ounces were pulled from the Asahi depository. 1.2 million ounces were pulled from the CNT depository. Another 1.2 million ounces were pulled from the JP Morgan vault. And nearly 800,000 ounces were pulled from Manfra, Tordella, and Brooks. This was a coordinated systemic raid across every major custodian in the COMEX network. And here is the smoking gun. This withdrawal happened on the exact same day that the paper price was smashed to $86. Do you think that is a coincidence? Do you think it is an accident that the price dropped $6 right before 4 million ounces left the building? No, it was a heist. The banks engineered the flash crash to $86 for one specific reason. They needed to settle their physical withdrawal requests at a discount. If you are withdrawing 4 million ounces, a $6 drop in the price saves you $24 million. They smashed the price to loot the vault. But the most terrifying number in the report isn't the total withdrawal. It is the collapse of registered silver. In the COMEX system, registered silver is the metal that is actually available for delivery against futures contracts. It is the inventory with a for sale sign on it. On Friday, the registered category plummeted by over 2.5 million ounces. It fell to just 120 million ounces. This is the buffer. This is the safety margin, and it is evaporating. When registered silver drops this fast, it means that the owners of that metal, the banks and the trading houses, are removing the for sale sign. They are moving the metal into private hands. They are taking it off the market. Why would they do this? Why would they remove inventory right when the price is hitting all-time highs? Because they know what is coming. They know about the Trump proclamation. They know about the Section 232 review. If the United States government is preparing to declare silver a critical mineral and implement price floors or export restrictions, you do not want your metal sitting in a public vault in New York. You want it out. You want it in a private vault. Or better yet, you want it out of the country. We suspect that a significant portion of this 4 million ounces is heading to London or Shanghai. The London Bullion Market Association, the LBMA, is reportedly dangerously low on float. The arbitrage gap with Shanghai is draining London just as fast as it is draining New York. The banks are playing a game of whack-a-mole. They are pulling metal from the COMEX to plug the holes in London. They are robbing Peter to pay Paul, but Paul is already bankrupt. This transfer of wealth from the public markets to the private hoards is the final stage of the squeeze. When you see 4 million ounces leave in a day, you are watching the liquidity of the market die. You are watching the exit door slam shut. And this brings us back to the U.S. mint price of $173. The mint knows the vaults are being drained. They know that if they tried to buy 4 million ounces to make coins, they couldn't do it. The metal isn't there. It has been spoken for. So we have a situation where the paper market says silver is $90. But the physical inventory underlying that market is disappearing at a rate that guarantees a default. If the COMEX continues to bleed at this rate, 4 million ounces a day, the registered inventory will be gone in 30 trading days. 30 days. That takes us exactly to the March delivery month. March is traditionally a massive delivery month for silver. The open interest data suggests that traders are standing for delivery in record numbers. They are rolling backward, as we discussed, to get metal now. But if the banks drain the vaults in January and February to ship the metal to China, what happens in March? There will be nothing left to deliver. This is the force majeure scenario. It is the moment when the exchange declares that it cannot fulfill its obligations. It is the moment when they tell the contract holders, sorry, we don't have the silver. Here's a check for the cash value. But as we know, industrial buyers don't want checks. They want silver. So the Friday night heist was not just a transaction. It was a signal that the insiders are getting out while the getting is good. They are taking their chips off the table. For the retail investor, this is the loudest warning bell you will ever hear. The banks are taking delivery. The government is suspending sales. The vaults are bleeding. If the biggest players in the world are grabbing physical metal and running for the exits, why are you still holding paper? The great repricing isn't just about the price going up. It is about the availability going to zero. In the next part of this deep dive, we are going to look at the retail swarm. And while the whales were raiding the vaults on Friday, the retail public was doing something equally historic. We have data from the Kobisi letter showing that retail investors have been buying silver ETFs for 169 consecutive days. This is the unstoppable force meeting the immovable object. The retail public is buying paper claims on silver at the exact moment the physical silver is being removed from the system. We are going to analyze this collision. We are going to explain why the ETF market is a trap, and how the 4.4 billion ounce short position held by Citibank and Bank of America is about to blow up in their faces. The vaults are empty, the mob is angry, and the short sellers are trapped. We have witnessed the sovereign default at the US Mint. We have witnessed the bank run at the COMEX vaults. But there's a third force in this market that is perhaps the most unpredictable of all, the retail public. For years, the silver market was a lonely place. It was inhabited by contrarians, preppers, and hard money enthusiasts. But over the last 6 months, something changed. The psychology of the average investor shifted. We have just received data from the Kobesi letter, one of the premier institutional analysis firms, that confirms a buying panic of historic proportions. Retail investors have been net buyers of the largest silver ETF, SLV, for 169 consecutive days. 169 days. That is nearly 6 months of relentless, non-stop accumulation. It is the longest buying streak on record. In the last 30 days alone, silver-linked ETFs have attracted over $920 million in inflows. Buying activity is running at more than double the 3-month average. To put this in context, the buying pressure we are seeing right now has officially surpassed the peaks of the 2021 silver squeeze. Back then, it was a flash mob organized on Reddit. It was loud, but it was short-lived. This time, it is different. This isn't a flash mob. This is a migration. This is capital fleeing the stock market, fleeing the bond market, and seeking safety in hard assets. But here is the tragedy of this situation. This massive wave of capital, billions of dollars, is flowing into the wrong vehicle. Most of this money is going into paper ETFs, like SLV. The retail investor thinks that by buying SLV, they are buying silver. They think they are taking metal off the market. They are wrong. When you buy a share of SLV, you are not buying a bar of silver. You are buying a trust unit that is backed by a claim on a bar of silver that sits in a vault controlled by JP Morgan. The same JP Morgan that we just saw draining its own vaults. This creates a conflict of interest so large it blocks out the sun. The custodian of the silver is also the largest short seller of the silver. This brings us to the villains of this story. We have reports indicating that major banks, specifically Bank of America and Citigroup, are sitting on a massive derivatives book. Some analysts estimate their gross short position in precious metals could be as high as 4.4 billion ounces. 4.4 billion ounces. Let's do the math. Global mining production is roughly 800 million ounces a year. These banks have sold paper contracts representing 5 years of total global production. They have sold silver that does not exist. They have sold silver that hasn't even been discovered yet. This is the definition of a naked short. And now they are trapped. On one side, they have the retail swarm pouring billions of dollars into the market, driving the price up. On the other side, they have the whales draining the physical vaults, removing the collateral. They are caught in a vice. If the price of silver rises to $100, the losses on a 4 billion ounce short position would be catastrophic. It would wipe out the equity of the banks. It would require a Federal Reserve bailout larger than 2008. This explains the violence of the price action. This explains why they smashed the price to $86 on Thursday. They are fighting for their lives, but the retail swarm is relentless. 169 days of buying proves that the public is not selling the dips. They are buying the dips. Every time the banks smash the price, the ETF inflows accelerate. The banks are trying to scare the public out, but they are only inviting them in at a better price. This is the unstoppable force meeting the immovable object. The unstoppable force is the inflation-fearing public. The immovable object is the insolvent banking cartel. Something has to give. And based on the vault data from Part 2, the thing that is giving is the physical inventory. The ETF structure acts as a buffer. It absorbs the retail demand and keeps it away from the physical market for a while. The authorized participants can use leasing and accounting tricks to satisfy the ETF rules without actually moving metal, but they cannot do it forever. Eventually, the disparity becomes too large. If SLV says it holds 500 million ounces, but the vaults are empty because the silver went to Shanghai, the ETF implodes. We are approaching the moment where the paper claims exceed the physical atoms by a ratio that triggers a default. For the individual investor, this data carries a stark warning. If you're a part of that 169-day streak and you're holding SLV, you are sitting in the danger zone. You are holding a receipt for a car that has already been stolen. When the squeeze finally breaks the banks, the ETFs will likely be settled in cash. They will give you dollars. But you don't want dollars. You want silver. The retail swarm has the right idea, buy silver, but the wrong execution. They are buying the map instead of the territory. This massive inflow of capital proves that the sentiment has shifted. The public is awake. They know the dollar is dying, they know inflation is lying, and they are voting with their wallets, but they are voting in a rigged ballot box. The Friday night heist we discussed in Part 2 was the smart money taking the physical metal before the ETF holders realize it is gone. So, where does this leave us for the Monday open? We have a market where the price is $90. The mint is at $173. Shanghai is at $102. And the banks are short 4 billion ounces. This is a powder keg. The retail buying is the fuse. The vault drain is the spark. And the explosion will be the repricing of silver to a level that balances the books. That level is not $90. It is not $100. In the final part of this deep dive, we are going to look at the verdict. We are going to combine the mint pricing, the vault drain, and the short position to calculate the true target. We are going to discuss the Monday gap. With all this news breaking over the weekend, the US mint repricing, the vault drain, the market is likely to panic at the open. And we are going to give you the final strategy for navigating the great repricing. The banks are trapped, the public is swarming, and the metal is gone. The only way out is up. We have arrived at the conclusion. If you have been with me through this forensic investigation, you now possess a picture of the market that the mainstream media refuses to show you. You understand the sovereign leak, where the US Mint admitted the real price is $173. You understand the Friday night heist, where 4.2 million ounces were looted from the vaults. And you understand the retail swarm that has trapped the banks in a 4 billion ounce short position. The evidence is overwhelming. It is not a theory. It is a mathematical disconnect that cannot be resolved without a massive repricing event. Today, Saturday, January 17th, 2026, we are staring at the largest pricing anomaly in the history of finance. Look at the numbers one last time. The spot price on the COMEX closed at $90.14. The Shanghai price closed at $102. The United States mint price is effectively $173. The gap between the paper price in New York and the sovereign price at the US Mint is $83. That is not a spread. That is a chasm. That is the Grand Canyon of financial risk. If you can buy a silver for $90, that represents an asset the government says is worth $173. You are looking at the trade of a lifetime. You are buying dollars for 50 cents, but this anomaly will not last. Markets abhor a vacuum. Physics demands equilibrium. There are only two ways this gap closes. Scenario 1. The US Mint is wrong. The shortage is fake. The 4 million ounces return to the vault, and the price crashes back to $90. Given the data we have analyzed, the inelastic industrial demand, the depleted mines, the retail hoarding, this scenario is impossible. The metal is gone. It is not coming back. Scenario 2. The paper price on the COMEX gaps up to meet the physical reality. This is the only path forward. The paper price is a lagging indicator. It is the last thing to move. The physical price leads, the Shanghai price confirms, and eventually the paper price capitulates. We are setting up for a Monday morning shock. While the markets are closed this weekend, the news of the US Mint repricing is spreading. The news of the vault drain is spreading. Investors around the world are doing the same math we just did. They are realizing that $90 is a gift. When the markets open in Asia on Sunday night and in New York on Monday morning, we expect to see a rush for liquidity. We expect to see traders trying to front-run the U.S. Mint. If the government thinks silver is worth $173, then $95 is cheap, $100 is cheap, $120 is cheap. This creates a buying panic that overrides the bank's suppression algorithms. So, what is the verdict? The verdict is that the great repricing has begun. The era of double-digit silver is effectively over in the real world, even if the screen hasn't caught up yet. The verdict is that the banks have lost control of the physical inventory, which means they have lost control of the price. They can print paper, but they cannot print metal. And the verdict is that we are witnessing a wealth transfer from those who trust the screen to those who trust the scale. So, what is your strategy? How do you navigate this chaos? Rule number 1, do not sell your physical metal. I know the temptation will be strong. If silver hits $100 next week, you will feel rich. You will want to cash out. But remember the U.S. Mint price. If you sell at $100, you're selling at a $73 discount to the government's own valuation. You are getting ripped off. Do not trade your scarce asset for a dying currency. Hold until the paper price matches the street price. Rule number 2, ignore the volatility. The banks are wounded, but they are not dead. They will try to smash the price again. They might try to drive it down to $88 to trigger stop losses. If you see a red candle on Monday, laugh at it. It is a fake signal. It is a paper game. The real game is played in the vault, and the vault is empty. Rule number 3, watch the spread. The most important chart right now is not the price of silver. It is the difference between the spot price and the physical price. As long as that spread exists, as long as the mint is higher than the COMEX, the bull market is intact. The squeeze is active. We are watching the collapse of a 50-year scheme to suppress the price of real money. It is messy. It is volatile. It is terrifying. But it is also the greatest opportunity of our lives. The United States government just tipped its hand. They told you what they think silver is worth. They told you it is worth $173. Believe them. The banks are short. The mint is closed. The vaults are empty. And the price is $90. You know what to do. Subscribe.